I think it's important to realize that we've become accustomed to very large shocks over the last couple of years. And I think it's important for people within banks to realize that from a macro lens, a trade war is negative, but not dramatic.
Hello and welcome. I'm Deepesh Patel, your host. Trade wars, reshoring, decoupling. How much of this is real risk and how much is just noise? I'm delighted to be sitting across the table from ING Bank's Chief Economist and Global Head of Research, Marieke Blom, to unpack what businesses are actually saying about geopolitical uncertainty. Turns out, many see opportunities where others see risk. Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance. Marieke, let's get started. So, quick introduction. Who are you, where are you from, and what do you do?
So I'm the chief economist of ING, a bank, which means that I'm an economist by background, of course. I graduated here, wrote my thesis at the Dutch Central Bank, so very much macro monetary economics as a background. But I get to lead a global team of about 80 people who are trying to make sense of everything that's going on in the world to make sure that our clients, our colleagues, and the broader public gets to make sense of everything that's going on. So we're very independent from the business, and we try to form our own views of economic impact, market impacts, and so forth.
Thank you. And there's a lot to try and make sense of right now. I mean, you mentioned earlier that when you spoke to companies about geopolitical risks, many of them actually saw these changes as manageable. Some even found opportunities. But that's not always the narrative we hear from the economists. Do you think there's a disconnect between how businesses and economists view global risks? And if so, what's driving that?
Yeah, so there's a real disconnect there. But you still see if there's a corporate risk list and they're being surveyed about geopolitical risk, they will still put this at the top of the risk list, right? So it's not as if they're saying it's unimportant. It's just that if you ask them about their company, they will tell me that's what they told me. Looking back, we've actually net seen it as beneficial or just about equal, so many different ways in which it affects us. And then some were saying, well, maybe it's been negative in the past, but looking forward, we believe that we'll be stronger than our competitors, for example. So I think that was a real disconnect for me when I started interviewing them. First thing I realized, of course, is I'm an economist. So I tend to be more gloomy than the average business leader, which probably needs a bit of an optimistic lens, right? In order to lead a business, you also need a good dose of optimism. But there's also, they're looking back. And when we look back at, so I spoke to European corporates, and when we do look back, I must admit that the European economy has been impacted, of course, by the trade wars, by Brexit, by the war in Ukraine. But it's also not as if we've seen something really dramatic happening, right? So if you look at economic growth, it has slowed, of course, as a consequence, but it hasn't been dramatic. And then when you think about it, of course, it makes sense that under these circumstances, there are a couple of corporates that are benefiting, actually, right? And the thing is, I do really believe that they underestimate, I would say, two or three things. I would say, firstly, they underestimate what I would call the tail risks. So like full decoupling from China or a real escalation of the war in Russia and Ukraine, for example. So they underestimate those tail risks. A second element I believe they underestimate is the fact that despite the war in Ukraine, the economy did well, which was very much on the back of COVID recovery, basically, the economy is reopening, but also a lot of government support. So they put in a lot of support packages for corporates, for households and so forth, which has really mitigated the negative impact. And then thirdly, as an economist, I look at trade longer term, and I would say long term, it is a downside for an economy if you're no longer able to open up further to globalization. And I think that's also like the gradual decline or erosion of growth is being underestimated.
I think you talked about peak globalization. We're at peak globalization right now. In your talk, you pointed out that trade war shifts tend to unfold quite gradually rather than causing sudden shocks. And businesses are clearly thinking ahead. They're doing more risk assessments, they're diversifying supply chains, and even accepting lower upside to reduce downside risk. Given that, should banks and financial institutions be adjusting how they assess risk, especially for these slow-moving but structural shifts?
Yeah. So I think it's important to realize that we've become accustomed to very large shocks over the last couple of years. And I think it's important for people within banks to realize that from a macro lens, a trade war is negative, but not dramatic. So you need to prepare for it, but not in a way in which you prepare for a shock, which is a different approach. So it's much more thinking about a gradual change in the stance, right, in the global cooperation and so forth. And you were saying we're still at peak globalization, and that's also important to realize. So when you look at trade, that's still at more or less the peak level as a percentage of GDP. Trading goods, that is. When you look at trade in services, that's still coming up, right? So you need as a bank to kind of look through the huge amount of very alarming headlines and think, okay, but what is really changing? And that's going way more gradual. And so adjustments can't take place overnight because simply even you could put a tariff on goods, but there's no industrial base, for example, in the US to replace it. So I think that's the first thing that's important. And then secondly, of course, you need to think about, but still some sectors may be hurt. And you need to think about, sort of make sure that you really understand their supply chains, that you think through it, but also be a bit careful. I always say to my colleagues in the risk department, let's also not try and worsen an economic cycle by putting a brake on too early, right? Because if you're really doing your risk assessment and your risk appetite differently because the situation changes, you might actually make it worse, right, as a consequence. So I think you have to be a bit careful, and I would say overall don't take the sort of the media drama for being the effective drama when it comes to your banking books.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. So let's keep the glass half full. Reshoring has been a hot topic, but from what you said, most companies aren't fully retreating from global trade. They're diversifying rather than withdrawing. How do you see this playing out for the Netherlands as a trading hub? And what does it mean for financial services?
Yeah. So basically it means that with every change in the global dynamics, there's some downside, but there's always some upside somewhere else, right? And the adaptability, the agility is very much a part of how companies deal with uncertainty, which means from the angle of the Netherlands, when it comes to trade, it will just simply diversify further. The companies will be working with different partners in different places, right? There will be new connections made to replace the existing connections, right? So it's much more a period of change than a period of decline overall when it comes to trade, right? And you need to position yourself for that. It does mean that probably the growth in trade is not going to be faster than GDP, which used to be the case. For a long period of time, we've seen trade growth really surpassing GDP growth, the era of globalization. And now probably it's going to be more or less in sync with GDP. That's trade in goods. Trade in services is still important to be positioned for. So with AI, with all the communication technology that we have available on a continent where labor scarcity is going to be limiting the upside potential of our economy, I do really believe that even global reorganization of services is going to become more important. And that's one thing that financial services organizations need to be prepared for. Another thing, it's not going to be dramatic shocks, but there may be shocks to the system. And everything that banks, financial institutions can do in order to provide hedges or forms of security for those corporates involved in international trade will become more and more important.
You touched on how European governments stepped in to shield businesses from energy price shocks and other economic disruptions. Looking ahead, do you see the EU shifting towards more direct financial support rather than heavy regulation? Or do you think that was just a temporary response?
Yeah, I think that was sort of the financial support is typically something you would do more for an energy sector because it directly impacts also people. But when it comes to the financial services, what you're seeing now is that Europe understands that in order for us to be powerful in the future, we need economic power. And in order for us to have economic power, we need a strong financial services sector. And I think when you look at it, there's room for further efficiencies. There's room for further cross-border integration in order to benefit more from economies of scale. And you can clearly see whether it's the Draghi report or the Compass for competitiveness, you can see that the European Commission is really thinking about, okay, how can we help the financial services sector in Europe to really support a strong economy? I think when it comes to whether you call it capital markets union or savings and investment union, Europe is going in the right direction. When it comes to even banking union, you may see some further steps. I was just looking at sort of the EU is actually these days coming out saying, okay, we may be looking at banking competitiveness sooner than we were originally thinking. So I think they will be thinking about ways of regulating, firstly, to make life easier for the existing organizations, but secondly, to allow for this market to have the scale that it has, basically, to benefit from efficiencies of scale. Yeah, probably support some consolidation efforts also in the sector.
Thank you. Marieke, final question. Let's talk about China. You also mentioned when you talked to those corporates about risks like decoupling from China, that wasn't at the top of mind for most. Many are preparing, but not necessarily panicking. How well do you think Europe is positioned for these kinds of shifts? And what do you think they're doing now to stay ahead?
What I found is when I spoke to European corporates, Russia is the first thing they think about. And of course, it makes a lot of sense that at this moment in time, this is what people are thinking about. Of course, longer term, the tension between China and the US will also have repercussions for Europe. This may be gradual and it can also be sudden, right? And that's, I think, one of the tail risks that is looming on the horizon. And the horizon is not necessarily a 10-year horizon, right? It's in the next, well, let's say 5 years or something. So I think whether it's a corporate or a bank, you need to think about what do the risks look like from my perspective? How am I exposed to China? What can I do? And you will have seen online that I've drafted what I call the resilience framework, which says basically make sure that you do risk assessment. Think about ways of reducing the risks. Think about ring fencing some of your activities and make sure that you have a rapid response in place. And so the things you can't prepare for, or basically you prepare for it. And once it happens, you have your plan B, or you are able to move at least. And I think that's also what the supervisor is asking, right? There's a lot of geopolitical stress testing demanded from banks as well. So I think you have to start thinking about the very unlikely but still possible scenario of full decoupling from China.
Thank you very much, Marieke. More risk assessments, but a real diversification from supply chains. Lots to unpack there, but I guess a glass half full approach to what's happening in the world right now. Here we are at the BAFT Europe Bank-to-Bank Forum here in Amsterdam. Marieke from ING, Chief Economist and Global Head of Research. Thank you very much for joining us.
You're welcome. Thanks.
And don't forget to follow Trade Treasury Payments
on your favorite podcast platform.
Thanks for listening.